Something very fascinating. So let me say this. We had a gap and trap today. NASDAQ gapped higher, slammed up into the trend line, and reversed and dropped by 3.5%. You can see the breakdown of the rising wedge. I warned about this, but the herd said, this time it's different, just like they always say. NASDAQ moved to a new high. The S&P did not. They did diverge. S&P made a slightly lower high than the peak that we had. The peak that we had on October 9th, on Thursday, was at 67.64. Our peak today, we went back up and tested that high, didn't exceed it, and we reached a peak of 67.62. The S&P went on to drop very quickly, 182 points, or 2.71%. You just see the collapse right here. This time, it's different. This is interesting. So the S&P topped out on Thursday, October 9th. Now, what I want to show you is what happened with the 2007 top and what's happening right now. Could we be topping? Yes, we could be topping it. We could have topped on Thursday, and the blow-off top could be done. Do not rule that out. The market could now possibly be over. We need to see more evidence of that. Taking out the 50-week moving average and taking out the 200-week moving average. Seeing the market collapse, seeing the Fed begin to panic. So possible we sell off and get one more push higher. We'll be watching for clues, but do not rule out the possibility that we have a top in. Back in September, Fed cut right here on the 17th. I've highlighted it there in red. If you count the session days going forward, from the day of the Fed cut, not including that day, but after, beginning with the day after, you get up to our peak, you get up to day 16. Today, on Friday that I'm making the video, the day we had the big sell-off, that's day 17. Just session days. I want to remind you, the Fed already cut right before the election in 2024 stock. It is possible the stock market is peaking. We've had a massive move higher. Again, I told you in April, at the April low, we are going to get a blow-off top. We've hit the trend line I was looking for us to reach without any kind of significant pullback. So we have to be open-minded to the possibility that, again, maybe we have now topped with Thursday's high. When the Fed cut on September 17th, the stock market so far, after that date, after the Fed cut, the next day, 16 days later, we have peaked. 16 trading sessions later, we have peaked. To include the Fed day, it's 17. If we look what happened back in 2007, Fed began to cut right before the market peaked. Now, we had cuts in 2024 right before the election. And the Fed paused. We just got in 2025, September of 2025, the Fed starting cuts again after they had paused. Rate cuts are associated with bear markets, and rate cuts are associated with a coming recession. Doing something very similar to what we did in 2007, where we had the Fed cut September 18th. The recent cut here was September 17th. The rate cut in 2024 was also on September 18th. It seems to start cutting rates around September. That's a joke. What happened is we got the rate cut, and the market topped 17 days later. 3.5 weeks later, the market topped. That's exactly what we had happen right now. We've had the market peak in just over 3 weeks as far as sessions, peaking 16 days after the Fed's first cut. Here it was 17 days after. Again, not including those Fed days the day after. Include the Fed day, it's 18 days here and 17 days on the other one. Very, very similar. Here we had the first cut in September 18th. We rallied up to a new high. We topped and we reversed 17 sessions later. Could we be topping right now? Yes. Because of the blow-off top. It was such an extreme rally that we've had that it is possible the blow-off top is done without any kind of meaningful pullback whatsoever. Now we're going to see a wrecking ball taken to the market. Very possible. We need to see evidence the top is in. There's a strong possibility that that could very well be the case. I'm very open-minded to that. We may get a pullback and may get one more final push higher in the fourth quarter here. Again, we would have to get evidence of that as well if we are going to go and make one more high. This could be it. Now, as what happened here is we began to see the market collapse. Now, what was going on in 2007 was we had the subprime mortgage crisis. We had the housing market in a free fall, collapsing throughout 2007. The housing bubble burst. You know, the housing bubble, the Fed told us, Ben Bernanke, there is no housing bubble. Remember that? It's like they told us inflation was transitory. By the way, the Fed throughout 2007 told us we were going to have a soft landing. There's not going to be a recession. Same nonsense they've been saying this time around. Remember, December of 2024, Ben Bernanke or Fed Chair Powell said, it's clear we've avoided a recession. Remember that in his press conference? Nevertheless, I digress. We had the subprime mortgage crisis. We had the housing market collapsing. We had stress in the credit market. So there were things going on here. It ended up giving us a sell-off. Now, we got the initial cut here in September of 2007, pardon me. We peaked 17 days later. We dropped down to the 200 period moving average, which was fairly close. Took it out, went down to the 400 period moving average and dropped nearly 11%. We rebounded back up to the 50 period moving average, overthrew it, and then we went to take out the 400 period moving average, and we ended up dropping by January. We ended up dropping after peaking in October 11th. We ended up dropping over 20%. We dropped 20.5%. Do you see this down here? 20.5% decline. And that's when the Fed panicked. Previously, I said, referring to the rate cuts starting, the jumbo cuts starting in January 2008 being the first cut, misspoke. That was 2001. 2001, January, the jumbo cuts. That was the first cut. So I apologize getting that mixed up. The first cut actually in September of 2018. We peaked 17 days later. Then we began to drop. We dropped 11%. We rebounded back up, and then we got another leg down, dropping 20%. That's when the Fed really panicked. We had a couple of cuts. Now look at these cuts. The cut after we peaked right here, we got another cut with this high right here on October 31st. Do you see this? We got a quarter point cut. Do you see that? That marked this top. Sold off, dropped the 11%. We rebounded back up to the 50 period, and this peak right here was on December 11th, and that was another quarter point cut. Both of those cuts after we had topped marked tops, short-term tops for lower highs, and then we kept going and making lower lows. Here we made a lower low beyond this level. Here we made a lower low beyond this level. Do you see this? We sold off, and then the Fed got more aggressive. We saw the Fed panic in January. I said the stock market had collapsed over 20%, and that's when the Fed really panicked. I think you're going to get a bigger crash than what we had off of the February high. Get it now, if we've topped, we should see a bigger crash than what we saw from the February peak down to the April low, which was 21% on the S&P 500, just under 26% on the NASDAQ. Go back and test the April low, you're going to drop 29%. That's assuming that we have topped, and again, the jury is still out on that at the moment. But these cuts marked lower highs. Then we got the Fed down here at this bottom. We were dropping. The market was in a free fall here. And then the Fed panicked, did 0.5% cut, started the jumbo cuts. An emergency meeting January 22nd. And then we had right after that, in late January, on January 30th, we had another 0.5% cut. So they cut by a whole percentage point in January with those two cuts. And we had the market in a free fall, and the Fed came in with the cut. We got a bottoming tail, a rebound, and right here, as we rally back up again, we got another the regular meeting in January, the scheduled meeting. We got the cut there again, 0.5%. The market went sideways, sold off some more, went back and moved slightly lower. And in March, we got another cut, another jumbo cut, 0.75%. And again, that produced another bottom. So the January cut over here and over here. And again, the one thing I'm trying to tell you is that you could see something similar to this. The Fed started cutting in September. We could see, okay, a September peak, the market top, and then we could start getting these cuts going forward penciled in our 2 more cuts for this year. We can get those cuts and still be declining. Again, those cuts mark the counter trends and still be declining until January. That's when the Fed panicked. And again, you might see something similar to that if the market did in fact just top on Thursday, October 9th. Here we topped October 11th. Very, very similar to what happened in 2007, topping 17 days later here. In our current situation, if we've topped on Thursday, you top 16 days later. These cuts, they gave us another rebound, and this time we went back to the 200 period moving average. The 50 had already crossed below the 200 back over here. You had the death cross, price holding below the 200. Again, you moved down to the 200, tried to get back above it, it failed. Tried to get back above it, it failed, and lost it. Went down to the 400 period, and then you lost the 400 period moving average. You got the miniature double bottom here, and that gave us a rally back up to the 200 and the 400 period back up here. And then after that, we collapsed to new lows. And we can go on. I just cut it off here, but we can go on all the way to the Lehman moment here. If I just zoom out and remove the annotations, you can see, again, here we peak back in October. The Fed's cut here, here, and the emergency cuts that started here, and here, and then again over here, it didn't stop the bear market. It gave us a counter trend bounce, and that's what's going to happen. The Fed's going to cut, and the people are going to go, it's over, and then we're going to get a rebound, and the selling's going to resume, and it's going to be followed by this. This is the Lehman moment over here in September during the financial crisis. 50 dropped below the 200 period moving average. It remained below the 200 period. You dropped below the 400 period, the red line there. You went back to the 400 and the 200 as they crossed, and then the bottom fell out of the stock market. Notice the 50 being below the 200 period the entire time, not being able to get back above it. The risk is that we're topping right here, right now. That is certainly possible. Rate cuts, it didn't stop the bear market from happening. That's what people don't understand. And again, it runs around and tells us how we're going to have these soft landings, which is a fairy tale. It's made up. The times that they claim we had a soft landing, we were still in an economic expansion. It's a bunch of Kool-Aid for the herd. To think that the Fed can actually control, micromanage the economy, Their policies always lead to negative outcomes. Their policies cause the problems. Fed, people say, the stock market, it crashed in 1929. That gave us a Great Depression. No, the Fed gave us a Great Depression. Their policies. They raised rates to nosebleed levels when there was no inflation. They caused it. They caused the inflation we just recently had. Taking rates, QE 2.0, and then the government doing government deficit spending, passing out, 5-6 trillion in checks. Well, the Fed enabled them to do that. Their policies always lead to negative outcomes, always. I wanted to show you the chart that, again, these rate cuts, they didn't stop the bear market, People tell me, we just got these tax cuts. The tax cuts are going to prevent a recession. No, they're not. If you look at the tax cuts back in 2001, tax cuts George W. Bush ran on, they got them passed. The bear market started. They only give us a counter trend. It didn't stop the bear market. It didn't stop the recession. Neither will the rate cuts. People believe they're bullish because of what happened in 2020 and the following in 2021. Well, the events that gave us all the inflation, it wasn't supply chain disruptions. That had a little bit to do with it. Yeah, somewhat to do with it. The Fed. It was the Fed's policies and the government doing government deficit spending that gave us all the inflation. It caused all these problems, and then they turn around and turn around and want to take credit for saving us all. It's absolutely incredible. Nevertheless, I digress. Again, these rate cuts over here, they did not stop. But again, I expect that we're going to see a crash. If we've peaked right now, you're going to see a crash. During the decline, we might see the two cuts that are penciled in for the year, like we got right here. It'd be interesting if they led to peaks in the market as well. And then eventually, again, by January, the Fed is going to panic. Maybe sooner if we have topped. Did you hear what I said? If. You know what the word if means? It means if. You need to see evidence of that. But I'm just telling you, we've hit my target level. We've hit that upper channel of the parallel channel on the S&P 500 that I've talked so much about. We've hit the upper boundary of the broadening formation on the NASDAQ. It is very possible we have a top. If we did top on Thursday, 16 days after the Fed cut, we'd be doing something very, very similar. Now, the only difference is that we had Powell had the Fed cut in late 2024 there, and I think the only reason why we got back those cuts right there is because we were moving into an election. Usually Fed chairs don't do that. Powell did. Then they went through this long period of pausing up until September 2025. Whatever the reason was or the motivation was for cutting, the cuts stopped. Now we're getting the cuts beginning again. Could see something like this begin to happen. Now here's the Fed funds rate right here in purple right here. And I think it's something very similar to what happened in 2020. We had the Fed begin to cut in August of 2019. And the market still ended up going higher into February of 2020. And that's right when the pandemic hit. They have the self-imposed shutdown of the economy. The S&P dropped 35% in 3.5 weeks. And then the Fed did QE 2.0. The government came in with the checks and we had this happen. Again, this is likely an outlier. This is why people believe, never seen a bear market, believe that the rate cuts, it's going to be so bullish. Usually the rate cuts are associated with bear markets, like over here with the bursting of the tech bubble, or over here. The rate cuts are associated with bear markets. And over here, but we're getting something very similar to what we had over here. The Fed had started to cut rates in 2019. The Fed did the pivot on August 1st, and we eventually ended up going higher. A lot of volatility in 2018. We went higher, and then eventually we got that pandemic hitting, and we ended up crashing. But that's when the Fed began to just do QE 2.0 and dropped rates down to nothing. You can see something very similar to that, where we saw the Fed begin to cut in 2024, and then they paused. And now we're getting the cut here in September. Do you see how it's turning down? We were paused there for about 9 months. The last cut in 2024, the Fed paused, and then now they're starting to cut again. So it could be something similar to this, where we could see a couple more cuts, but eventually the Fed panics and starts doing jumbo cuts, start getting something like what we had, back over here or back in 2022. Remember, we're in the government shutdown right now. 2018, Bitcoin got a 20% drop. S&P was in a downtrend. Right now, it's in an uptrend, so it could do something similar to what Bitcoin did. Bitcoin, I don't know if you noticed today, but it collapsed 10% from on Friday from the open to the low. Moved off of the lows, but it still collapsed in one day by 10%. You're really starting to see market play catch up. Could we see something similar to what we had over here? I'm not saying something similar to rebounding back up and seeing the government come in with stimulus checks. That's not going to happen again. We'll eventually do QE again, but again, we still have quantitative tightening. Right now, the Fed is still engaged in quantitative tightening, reducing their balance sheet. Eventually, that's going to come to a stop, and eventually they'll revert back to the QE after more rate cuts. Eventually, that will come, trying to artificially prop up the market to prevent a collapse in markets and to try to avoid a recession. They won't be successful. They never are, because their policies lead to negative outcomes. So I just wanted to share this topping process here with you. And again, we're on the same path that we were back over here. The September cut, the October top, same path that we took in 2007. See if the S&P gets an 11% drop. If we do what we did back in July of 2024, that was a 10% drop. It would take us back down to the 200 period moving average on the S&P. Watching to see, did we just top? So you can expect something like this, the market to collapse and then the Fed to eventually panic, drop more than 20%, to try to artificially prop up the market, a massive rally back up to the 200 here. If we get a sharp decline below it, that would be an area to be watching. If, in fact, we have started the bear market, if the market has now, in fact, topped. We are on the same path as we were back in 2007. So far, the same month, September, October. By the way, we're not getting any economic data right now. The government is shut down. We end up getting a really ugly jobs report and tank the market. I told you, even if we get a positive number, that could tank the market because then they think that we don't get any more rate cuts in 2025. But I'm just telling you, again, we've already started to get a negative number in June. We start seeing more negative numbers and more deterioration in the labor market. The Fed, and that could be a catalyst. Back in 2007, we started seeing negative numbers show up with the August report that we got in September. We started seeing a negative number, and the amount of job creation, market shrugged it off, still went higher. Remember, we got that revision with the previous jobs report. The last jobs report, the revision, showed a negative number in June. Still saw the stock market reach new highs this week, shrugging it off. But then we ended up getting the September report. We ended up seeing the September report, and we got that October 5th, showed a larger negative number, and the market ended up topping with that jobs report. We still got some positive numbers after, and then in 2008, every single number was negative. So if we get this jobs report, and it ends up being a big negative number, again, it could possibly be a top in the market. We got the September jobs report on October 5th. We got the jobs report on October 5th, which is right here. The jobs report came on that Friday, at the first Friday of the month in October, and 4 days later, the stock market peaked on Thursday, October 11th, 4 days after that. And again, we had the subprime mortgage crisis going on. We had the housing market in a free fall. Got more cuts out of the Fed, but the market continued to drop until January. Let me just bring this back up, and I'm going to remove the cloud and some of these moving averages so you can see this nice and clean. That jobs report, October 5th, and again, 4 sessions later, we topped on October 11th at negative, I think it was negative 159,000. We start getting government reopening, and we start getting the economic data, and we see an ugly jobs report. That very well could be it. We got the weakness in the labor market. We have deterioration in the labor market right now. We had fewer jobs created in 2024 than 2023. Now we're seeing more erosion in the labor market with our recent weakness. Clearly, there's a deterioration in the labor market. A huge warning sign that we're moving closer towards recession. What happens is the stock market peaks ahead of the recession right before it starts, begins to crash. Usually you have the Fed panicking just right before the recession starts or right after the recession starts. They realize their soft landing fairy tale isn't going to happen after all, and they begin to panic. So just pointing out, there's a lot of similarities with what's going on with the labor market right now, a lot of similarities with our September cut, our possible October peaks, and then again, if we get a couple more cuts out of the Fed here for the balance of the year, we could start seeing the market go down. We could see a collapse by January if we can't get a rebound back up. Let me just remove some of the shorter term moving averages in the cloud here because I just want you to see the longer term moving averages, the 50, the 200 period, the 400 period moving average here in red. And again, we had the moving averages closer to one another, the 50 and the 200 here, surrounding the October 2007 top. They're further away right now, so we could see a more dramatic move to start pulling down the 50-period moving average in our current market right now. But it's what you want to be watching for as they move towards the 200 or 400 period moving average, taking out the 50, eventually moving back to the 50, and again, ahead of a death cross, then eventually taking out the 400 period moving average. Gave us a short-term double bottom here by the Fed rate cuts, the panicking here in January of 2008, the March cut, and that gave us a rally back to the 200 period. Oh, it's over, it's over, it's over. And then the market went on after that to have the bottom fall out of the stock market after rejection at the 200 and 400. The 200 had just crossed below the 400 period moving average. The 50 remained below both the entire time. So just watch, again, for these rallies surrounding the 400 period, and then here surrounding a bigger 20+% drop. And again, the rallies back to the 50, back to the 200 period. This is what often happens, and usually the way it plays out back and getting rejection at the 50, going back and getting rejection at the 200. And it was very similar to that in 2022. And let me just bring that up close so you can see it. And by the way, you had a divergence at the 2020 or 2007 peak, I should say. I'm sorry. You had a multiple point divergence here in 2022. You've got a multiple point divergence right now. Very, very similar divergences over just a few months. Now, this was the 2022 sell-off. Again, you had the peak. You dropped below the 50 period. You lost it. Okay. You came down, lost the 200, tried to get back above it, and you came down to just above the 400 period moving average, rebounded back up above the 50. The 50 crossed the 200, and then got a bigger sell-off. That bigger sell-off went back up to the 200 here. So again, just overthrowing that 50 as it was crossing the 200, or actually even overthrowing the 200 period, making another attempt to back above it. But the 50 and the 200, notice the 50 got below the 200. It remained below it through the duration of the sell-off. Three important moving averages to be watching if we have peaked is the 50, the 200, and then the death cross, and then the 400 period moving average for a potential bottom, an area for a bottom, and then also going back up and testing the 400 period and the 200 period as they get across. Eventually, we saw a bottom and got back above these moving averages. It's a very similar pattern surrounding market tops, the 50, the 200, 400 period moving average. Just quickly, here is our current price action. We had that big drop on Friday. We've got this multiple point negative divergence, just like back in 2022, just like back in 2007. But notice the 50 is very far away from the 200. So you're probably going to get a dramatic sell-off. And if we go down to the 400 period moving average, that's currently at our 50% retracement. This is our Fibonacci levels. We could see a move towards the 400 period moving average if we've topped, end up taking out the 200, or even overthrow the 400 period moving average and move towards the 61 point of Fibonacci. We did overthrow it over here, but got back above it. But if we have topped, you want to be watching. This has completed the blow-off top. You want to be watching the Fibonacci levels. I went through them in the last video. Here they are again. Again, our 38.2 is near our 200 period at the moment. Again, these Fibonacci's are very, very close to these moving averages at the moment. 400 period near that 50% retracement. So again, I'd be watching the 400 period moving average. I'd be watching the 200 period moving average. If we bounce off one of those, you can rally back up towards the 50 period moving average, towards the 50 period moving average. If we have topped, eventually losing the 400 period moving average or dropping below it, getting back above it, and then coming back down and losing it completely. If we've topped, watch for rallies after a big sell-off. Watch for rallies back to the 50, back to the 200 period. And again, if we have topped, we need to lose the 400 period moving average and stay below it. If we move down to the 400 period moving average, the red line you see right there, you're going to be moving down about 14.5% if we end up going down that low from where it is currently at. If we go to the 200 period moving average, you're looking at going down just over 10.5%, which is very similar to the drop of 10% that we had back in 2024. It's the first leg down of the broadening formation in the NASDAQ that I showed you in my last update. I've talked about in every single video. So to the 200, over a 10.5% sell-off, about a 14.5% sell-off to our 400 period moving average. I'd be watching these moving averages very closely. If we take out our 50 period, which again, we may bounce off of it and try to back test the trend line from 2000 or from May of 2025 that we just broke. I featured that in my last video. And again, just be aware that again with the negative number, we topped 4 days later, got a couple of positive numbers after that, but in 2008, then we got nothing but negative numbers. The negative numbers that we started seeing show up in 2007 were followed by nothing but negative numbers in 2008. The deterioration in the labor market is one of the early signs that recession is going to happen. Sometimes it happens just as recession is starting or right before it. This next jobs report that we get once the government reopens is going to be very, very important to be paying attention to. As I've warned you, again, I do expect we're going to see more negative numbers. We are moving into recession. We already have. And there are several recession indicators flashing. Back in 2007, we had the inverted yield curve. It uninverted 2007, just like it uninverted in 2024. I think it was December. Then it eventually inverted again, and eventually you've got the steepening of the yield curve, but it uninverted, then it inverted again for the second time, and you had the steepening of the yield curve, and eventually the market topped out and recession happened. Let me go down just a little further here and up here a little bit so you can see again the steepening of the yield curve, and this is warning us recession is about to happen. It's a very, very similar situation, although we've had several invertings here. We only had one right before the top and then right before the bear market began and right before the recession hit, which is the gray shaded area. 2007, and again, you can see the Fed cut, the market topped October 11th. We got these other cuts over here, and then here, down here, we dropped 20%, and the Fed panicked with an emergency cut there in January, on January 22nd. Here, I have the S&P below. I have, again, the longest inverting of the yield curve in history. We saw it uninvert. December, it inverted again, and then it unverted, and it's done it a couple of times here, but again, eventually, and that's allowed the market to go higher and top into this trend line. This is the trend line I've been talking about a very long time. The trend line from the 2020 low connected to the 2022 low, connected to the 2023 low, connected to the 2025 low. Went up and we hit this channel, and we're turning off of it right now. So again, you got a good shot that maybe that is a top, but you'll have to see the steepening of the yield curve. And again, when you get the market topping, you get the steepening of the yield curve, and you get the recession following shortly thereafter. Now, again, most people go, well, what happened in 2020 and 2021? We had a crash in 20 just before the recession, but they papered over it. QE 2.0. We got the 5-6 trillion in stimulus checks, and that gave us this big push higher, but it gave us all the inflation. That's given us this massive, massive bubble, biggest bubble in history, based on the Buffett indicator, based on other valuations that tell us that we are in a bubble, the biggest bubble in history. There are several recession signals flashing. The Fed, just like the herd, they don't believe the recession indicators. I happen to believe the recession indicators. What happened in 2020 and 2021 was an outlier, not what usually happens. We did get a crash of 35%. Again, they can't turn around right now and pass out stimulus checks. That would create a massive amount of inflation. Got to let this thing just happen, and a resetting of the financial markets and of the economy. By the way, this is the yield curve between the 10-year and the 3-month that we're looking at.